Good morning and welcome to the very first episode of the Texas Market Brief. I'm Kyle Grimshaw with the Grimshaw Home Group here in Central Texas. Today is Monday, June 1st, 2026. If you own a home, want to buy one, want to sell one, invest in real estate, run a business, or just want to understand where the economy is heading, you're in the right place. On this show, 3 times a week, we break down the biggest stories in housing, interest rates, the economy, and policy. And more importantly, what they actually mean for Texans. So here's the big picture this morning. Mortgage rates are still elevated. Texas buyers finally have more options, and Wall Street is starting to ask the very important question about the AI boom. When does all the spending actually pay off? Let's get into it. For our first story, mortgage rates remain elevated as we head into June. According to Freddie Mac, the average 30-year fixed mortgage rate rose to 6.53% as of May 28th. That's up slightly from 6.51% the previous week, but still below 6.89% from a year ago. Freddie Mac, now, here's the part a lot of people miss. Mortgage rates do not simply move because the Federal Reserve moves short-term rates. Mortgage rates are influenced much more heavily by the actual bond market, especially the 10-year Treasury yield. And over the past several weeks, Treasury yields have stayed elevated as investors keep watching inflation, energy prices, and global instability. Translation? For buyers, affordability is still the biggest hurdle in this market. And for sellers, you can't just list a home and hope. Pricing, presentation, and strategy matter much more than they did a few years ago. The bottom line is this: if rates stay high, buyers stay payment sensitive, and when buyers get payment sensitive, every pricing mistake gets exposed. That's the market we're in right now. For our second story, the economy is still running hot. So let's zoom out. The latest reading from the Institute for Supply Management showed U.S. manufacturing is expanding in May, with the PMI coming out in 54, the highest reading since May of 22. That marks the 5th straight consecutive year of expansion, according to the IMS. At first glance, that sounds like pure good news, and in many ways it is. A stronger manufacturing sector usually means businesses are ordering more, producing more, feeling confident enough to invest. But here's the catch. When the economy stays stronger than expected, inflation can stay stickier than expected as well. When inflation stays sticky, interest rates tend to stay higher for longer. So yes, a strong economy is generally positive, but for buyers waiting on some dramatic drop in mortgage rates, stronger economic data can actually delay that relief. That's why every major economic report matters right now, not just to Wall Street, but to anybody thinking about buying, selling, or investing in real estate in Texas this year. Now let's bring it home to Texas real estate. One of the most important shifts in this market is that buyers finally have options again. According to the Texas Real Estate Research Center, active inventory in Texas has climbed to roughly 139,300 homes in March, which is up 7.2% year over year, with statewide supply reaching 5 months. Homes are also taking longer to sell, and seller price cuts have grown larger. That's a very different market from what we saw in 2021 and 2022. Back then, buyers were rushing, waving, overbidding, and competing for almost everything. Today, builders are offering incentives. Some sellers are offering concessions, and buyers in many markets have more negotiating power. Now, that doesn't mean homes are suddenly cheap. It means the market is becoming more balanced. And in my opinion, that's a lot healthier. A balanced market is better for buyers because they have time to think. It's also better for sellers because realistic pricing and good preparation still gets results. And it's better for the long-term health of housing because it moves us away from panic and back to fundamentals. That's a much more sustainable market than the frenzy we lived in through a few years ago. Now, here's a story I'm watching closely because it could quickly become much bigger over the rest of this year. For the last couple of years, investors have cheered almost any company spending heavily on AI. Now, they're starting to ask tougher questions. Specifically, what is the return? Reuters reported in April that Amazon, Microsoft, Meta, and Alphabet are all on track to spend about $600 billion on AI this year, and that investors are increasingly pressing these companies to show when those investments will translate into real returns. Now, CNBC reports that Amazon is not backing off. In fact, CEO Andy Jassy has openly defended the company's roughly $200 billion 2026 capital spending plan, saying Amazon is investing aggressively to lead in AI and that the payoff will come later. Microsoft, however, is a little more complicated. Investor pressure has grown as Wall Street looks for clear AI payoffs. And separate reporting says Microsoft has reportedly canceled some of their Claude code licenses in one division and shifted employees toward lower cost in-house tools. That is from Yahoo Finance. So the real story here is not AI is over. The real story is that the AI race is getting expensive, and the market is beginning to care a lot more about discipline, margins, and actual returns. Why does this matter to the average viewer? Because when the biggest companies in the world are spending at that scale, it affects hiring, capital markets, sentiment, and potentially the broader economy. And if investor appetite for massive AI spending cools off, that can ripple well beyond Silicon Valley. If there's one market signal I'm watching closely this week, it's still the bond market. A lot of people are focused on the Federal Reserve. I'm focused personally on the Treasury yields because if yields stay elevated, the mortgage rates are going to stay elevated too. If inflation cools and yields start moving lower, that could finally give buyers some breathing room. And here in Texas, that could be one of the biggest factors shaping the second half of 2026. The other thing I'm watching is whether this AI spending story turns into a broader market narrative. If investors keep demanding payoff over promises, that could become one of the biggest business themes of the summer. Now, to close it all out, if you found this helpful, make sure you subscribe. And if there's a topic you want covered on this show, mortgage rates, Central Texas housing, investing, legislation, or the broader economy, drop it in the comments. On Wednesday, we're tackling one of the most misunderstood topics in housing: why the Federal Reserve does not directly control mortgage rates. And more importantly, what actually does. I'm Kyle Grimshaw with the Grimshaw Home Group. Thanks for joining me for episode 1 of the Texas Market Brief.